Welcome back, everyone. We have an exciting episode to get into today. We're going to be looking at companies and ranking them. I have a tier list ranking here from S tier to F tier. And then as you can see, we have a bunch of logos there of popular companies. These were the most requested to be ranked. Companies like Ulta Beauty, Google, Disney, Amazon, Intel, Tattoo Chef. We have Palantir, Apple, Netflix, Airbnb, Tesla, and a handful of more. So we have a lot of companies here. Now, what am I going to be ranking them on? I'm going to be ranking them on their cash flows. Because as an investor, when you buy a company, what you're really buying is the cash flows of the company. That's what you really are paying for. You're not paying for the revenue. You're not paying for the EBITDA. You're not paying for the earnings. You're paying for the cash flows. So what we're going to be doing is looking at all of these companies. And then I'm going to be assessing their cash flows using the website Qualtrim, where I can clearly see their historical cash flows. And as I'm doing this assessment, I'll be factoring in a lot of different things, like the volatility of cash flows, if it's growing or declining, if it's being eaten up by stock-based compensation, so on and so forth. And then when I make the final judgment on the companies, I'll be putting them where they rightfully belong. So you'll be able to see how these companies stack up against each other. Now, having said that, let's go ahead and jump right in. We can start off with Ulta Beauty right here. Like I said, we're going to be using Qualtrim Insights. This website is available to all Patreon members, so you can try it out with a free trial. But we plug in Ulta here, ticker symbol ULTA, and Ulta Beauty is a physical retailer that sells cosmetic, beauty products, hair products. They're very popular all across the United States. I've looked at this company before and actually done analysis on it, and I've been impressed overall with this company. So everything that I've looked at, I think it's a really well-managed, well-ran company. Let's go ahead and take a look at the cash flows. If we flip over to annual here, we can bring up the free cash flow. Now, obviously, what I'm seeing right now is Ulta Beauty back in 2008 and 2009 had negative cash flows. They're probably reinvesting in their business. It flipped to positive in 2010, and then it really took off in 2017. This is when the cash flows really increased. So 2017 to 2022, steady trend upwards. Now we can factor in stock-based compensation. Stock-based compensation is kind of the silent killer of cash flows. It doesn't show up in the cash flow statement because it's a non-cash expense, but it's basically the company diluting you, the shareholder, to pay the employees. So what I did here was create a new tab that shows the free cash flows against stock-based compensation. SBC, stock-based compensation, is these bars in purple. The free cash flows are in orange. As we can see here, even as the cash flows continue to grow for Ulta, the investor is not being diluted. The actual amount of stock-based compensation for this company is very low because I think most employees that work at Ulta, they don't really need to be paid in stock as much as other companies. So we look at this and we see a company that has growing free cash flows on a steady trend. It also has very low stock-based compensation. Even when I flip this over to quarterly, we can take another look here. And we see basically the same trend, growing year over year at pace. So immediately when I look at this company, I see one that has a fantastic free cash flow profile so far. Growing free cash flows year over year with very minimal volatility, not much volatility historically. The stock-based compensation or the dilution doesn't eat into the investors' returns, allowing them to do steady share buybacks and have a high free cash flow yield, a real high free cash flow yield. So when I look at this company, I'm going to go ahead and do it. I'm going to throw this one as S tier. I actually think that right now, Ulta Beauty has an S tier free cash flow yield. Crazy. And I wouldn't think that the first time looking at the logo or just looking at the company, but I really think this one is about as strong as it gets. I can't find any faults with this company's free cash flow. Now, next up, we have Google here. Let's go ahead and take a look at that one. Google's an investment I hold. I'm very bullish on the company. I obviously am biased. I love YouTube. I love the properties that Google owns. The company's had a little bit of a tough year. And if we look at the free cash flow profile, it looks overall very strong. We have decent growth for the past decade, but it's grown at around 15% for 10 years, and then it quickly doubled in 2020 because of all the content and the focus on staying home, watching lots of videos. I think that really helped out Google. You can see the strong growth in a single year. Now, one thing that's interesting about Google, though, and I think something that a lot of investors aren't aware of, is obviously this company is a big tech company. They have lots of employees, and they're paying these employees a high salary. Part of the compensation of a tech employee is typically stock-based compensation. So when you just factor in cash, the actual cash you're paying employees, that only is like 60% of their salary, 60 or 70% at most. Really, they're getting paid 40 or 50% in stock. When we factor in that stock-based compensation, the expense to the shareholder, it doesn't look quite as good. Do we see the trend here? Can you see this clearly what's happening? The purple line here, the stock-based compensation, eats up around 1/3 to 40% of their actual free cash flows. Another way to think of this is as they're growing their cash flows, they're diluting the shareholders so you have less ownership of those cash flows. So if Google announces that they're doing $15 billion in share buybacks, they're diluting shareholders by about $6 billion. So then they're only doing maybe $9 billion in share buyback net. So this is why I show this. Overall, I really like Google's free cash flow, but I think that stock-based compensation is a growing problem in it. It's a growing trend. It continues to eat a large amount of it. And don't get me wrong, even with stock-based compensation, it looks really good. Another problem we have here, though, is it's starting to trend back downwards. I've made some predictions on this. I thought that Google's free cash flows went up too fast and there's going to be a little bit of a reversion to the mean, but we see that happening. Quarter after quarter, it continues to trend downwards. Over the long term, I still think really, really good. I like this holding. Obviously, I'm invested in it. But I have to say that I don't think that Google has as good of a free cash flow profile as Ulta Beauty. In fact, Ulta Beauty could buy back 8% of their shares outstanding over the trailing year. Google, because of their level of dilution, can only buy back 2%. Their free cash flow simply can't go as far because of the level of dilution. So with Google, this is going to be a little bit surprising. I think upsetting to a lot of people, but I'm actually going to rank it lower than Ulta. I think Ulta's is S tier right now. I think Google's is A tier. And if you think I'm wrong, look at the data. Look at the amount of actual free cash flows investors are getting. Look how many share buybacks they can do. Look at the free cash flow profile and yield of the company. I think you'll come to the same conclusion. Now, after Google, of course, we have Disney. This is a company that I also have been invested in for a couple of years now. It has not performed well. Let's go ahead and take a look at this one. Disney, of course, has had a lot of challenges over the past couple of years with the lockdowns and the parks and everything like that. Most of that has recovered, but their free cash flows have not recovered. In fact, their free cash flows are in a strong, steady downward trend to almost zilch. Now, why is this happening? It's happening because of streaming. Disney is going into streaming in a very big way. They have created Disney Plus. They're gaining subscribers. But Disney Plus, since the day it was created, since they actually released it, it's lost over $8 billion. That's the total losses from it. Disney Plus is a money hole from the company, at least right now. Maybe 3 or 4 years, it will be a money generative thing, but right now it's costing them a fortune. And when we look at the free cash flows of this company, there's just no way around it. It's not good. The free cash flows have gone down since 2017 dramatically, and then the stock-based compensation has gone up. The last couple of quarters that you might be able to see there, stock-based compensation is higher than their amounts of free cash flow. So now they're diluting shareholders more than the actual free cash flows they're generating. Not a good thing for Disney. The stock price has been hurt as a result. Looking at the situation right now, even though I'm an investor in Disney and hopefully they can turn around things in the future, I have to be honest here. This one does not look good. Right now, their free cash flow profile is pretty bad. I'm going to go ahead and give this one a C. So right now, this is already starting to look a little bit interesting. We have Ulta as S tier, Google as A tier, and Disney as C tier. And remember, before you fight me on this, we're ranking the free cash flows of the company. The numbers speak for themselves. Next up, we have Amazon. Let's go ahead and take a look at this one. Amazon is another company that I have a large position in. So this company is meaningful to me. I have a large investment in it. I'll try to remain unbiased as possible, making my judgments on this company. If we look annually here, the past free cash flow of Amazon, it's been low for a decade or two, and then it suddenly spiked up. We have 2015, 16, 18, 19, and 20. From 2018 to 2020, Amazon generated $64 billion in free cash flow. So at that point in time, it was exciting. This company was making lots of money. Investors were enthusiastic, but then you can see what happened. 2021 happened. The free cash flows go to minus $15 billion. Very radical change. Now, when we filter by quarterly here, and we look at the more updated quarters, you can see the problem has only gotten worse. In 2022, we're getting these massive negative free cash flow numbers. Amazon just keeps pouring more and more money into investments, lots of cash flows out. And then when you add in stock-based compensation, Amazon hired 800,000 employees or something insane like that. They doubled the size of their company over the past couple of years. And we can see the purple bars here, the stock-based compensation from all of their employees start to really climb aggressively. Right as their free cash flows are going down, the stock-based compensation is going up. The the two worst things that can happen are happening at the same time. And I think this is part of the reason why Amazon stock is in the gutter right now. So looking at this, it really is just the worst trends in both directions. Stock-based compensation is going up, free cash flows are going down. It's not what investors want to see. Now, I look at this company unbiasedly, judging the free cash flows and how they stand right now. I think it's terrible. I think this is one of the worst looking companies in the market when you're judging the current free cash flows. The thesis on it is that down the road, these investments will pay off. The core business will start generating free cash flows. But look, that's in the future. That's theoretical stuff. What we have right now, the evidence we've seen, is that Amazon does not have good free cash flows. And when I rank this, it makes me a little sad to say this as a big Amazon shareholder, but I just have to be honest here. I rank it as an F. Right now, it just looks bad, so I think it belongs in this category. Now, next up, we have Intel. This is a pretty popular company, popular stock amongst value investors. I think it's one of the more popular ones on Everything Money. Let's go ahead and check out Intel here. We look at Intel, and they're the big chip maker. I don't know too much about this industry, so I stayed out of these type of companies. My biggest chip maker is Apple. I consider it to be in that category now that they make it for their own company. But we look at this company, and it has pretty strong fundamentals overall. I know it's been struggling recently. The stock price has really been hit this year along with other companies. But I look at the long history of Intel, and I do see a company that generates pretty consistent. I guess it's not 100%. They are cyclical, like a lot of chip makers. During down markets, you're going to see things go down a bit. But overall, you have a company that's generated a lot of free cash flow over a long period of time. And even more recently, it looks better over the past 6 or 7 years until we get to just this year, the past couple of quarters. Now, when I look at this, I think so far, the broad picture looks like a pretty strong company. It looks like it's running into some recent trouble here. When we look at the actual stock-based compensation of the company, it's pretty minimal over the long-term trend. But again, the past couple of quarters don't look good. We have stock-based comp going up and free cash flows going down. I think this one's pretty good. I'm going to give Intel a B. I think this is where it belongs. It's good. I don't think it's the most incredible one. It doesn't have ironclad, solid free cash flow every single quarter, no matter what. It does have some cyclicality. It has some volatility. It's struggling a little bit this year, but overall, I think it has a good history. And so I rate this one as a B. Now, next up, we have Tattooed Chef here. This is a smaller company, and I believe this one is a Jeremy Holdings. So let's go ahead and check out Tattooed Chef here. For those of you that don't know, this company is a producer of frozen plant-based food, and you'll see some of their stuff in Target, Costco. You see it in the frozen aisle there. They have different mixtures of veggies and different things. Pretty good food, good product. Now, looking at the fundamentals, again, this is a smaller company, so they're probably doing major investments. Right off the bat, I'm going to try to be more, a little bit easier on this one because they're in the early life cycles of a company. When we look at this one, though, there's no way around it. The free cash flow looks pretty bad. There's not much of it, and what we do have is just overwhelmingly negative. Minus millions of dollars, 10 million, 20 million every single year. Now, of course, the argument for this is that these are investments. They're spending cash right now that's going to later have a big return, right? That's what we're doing here. Same type of idea with Amazon. But we factor in stock-based compensation. We have stock-based comp of a couple million. This is probably the executives at the top getting paid. And then we have the free cash flow and the negative, minus 30 million as of last quarter. Right now, this company has never generated positive free cash flow. Now, again, small company, not really at the stages of real profitability right now. But looking at this one, there's no way around it. Tattoo Chef it's an F. There's no way around it. Maybe it will change in the future. That's the hope if you're an investor. You're looking at the free cash flows and what they're spending right now, hoping it will give a good return later. But I'm putting it right there alongside Amazon. Company loses money every quarter. It's got to be placed as an F. Now, after Tattoo Chef, we're moving to Apple. Little bit different in size here. Let's go ahead and check out Apple. Big disclaimer here. Apple's one of my biggest holdings. It's been a really great holding for me. I've bought Apple. I actually bought it back in 2017. I've continually added to it. I've been a big fan of the company, the products. I'm an Apple fanboy. I love basically everything they do. I think they make fantastic devices. And I think that it's a great, well-managed company. I really like basically everything about the company. I think it's Warren Buffett's best buy over the past decade. If we look at the free cash flows of this company, there's also no way around it. It is incredibly good. Very strong, consistent free cash flow over decades of time. Since 2009, they've just grown it consistently. Then we factor in stock-based comp. the silent killer of many big tech companies like Google for one of them, eating up a lot of it. And with Apple, you see a different picture here. The stock-based comp only takes up a fraction of the total free cash flow, around 8 to 10%. Not 30 or 40, 8 to 10%. That is very good cost structure and management of your employee growth. So if we look at the yearly, we can see this more clearly. Look at annual here. Free cash flow growing like crazy, and then stock-based comp factored in, very small percentage of it. Apple generates real profits that can be returned to the investor quarter by quarter. And they also don't have a lot of volatility. I mean, every single quarter, look at this. Every single quarter is above $20 billion. You got to go back 6 quarters to get to 17 billion. They're generating real profits quarter after quarter. That's why you see Apple as a company worth more than Amazon, Google, and Meta combined. It is a massive cash producing company. And at the end of the day, cash flows are what you're buying. For me, this one is S tier. I think it's right up there in the perfect as it can possibly be free cash flow profile. Looking at these so far, I think I have them right so far. You can let me know if you disagree with any of my assessments on this, but I think we've done a good job so far. The next one we have is Netflix here. Quick disclaimer here, I do own shares in this company. It's had a very rough year, so it's had a very difficult time with the slowdown in streaming growth. But let's go ahead and look at the actual numbers here. How does the cash flows look for Netflix? This is one of those companies that was a money-losing company for a long period of time, but Netflix had a very specific reason for doing this. If you read their earlier reports, the reason that they chose to throw all of their cash into investments, to throw it all into content, is they knew competition was coming. They knew it way back in 2014. They said that these companies like Disney, these companies like HBO, they're not going to license their content to me forever. They're eventually going to wise up. By that time, we need to have our own originals. So they put major investments back into the company. And you can see that starting to pay off. They had the cash flows go from negative to positive over 2020. And you can see that trend start to go in the right direction. So when I look at this, it's actually a pretty positive trend. It's going negative here and it's starting to swing back upwards into the positive. Now, another thing that I do like about Netflix, when we look at stock-based compensation, a lot of companies, they really like to dilute the shareholder. It's an easy way to pay employees. You don't have to worry about cash flows. You can just dilute and dilute. Netflix really didn't like doing this from the beginning because they always considered their stock to be undervalued. So they rather pay employees with cash than stock because the stock was worth more than cash. So they made a value judgment there. They thought their company was so valuable years and years ago that they really did minimal dilution. Stock-based compensation has climbed a little bit, but it really hasn't skyrocketed like a lot of other companies. And we're starting to see the free cash flows move into the positive. So overall, it's not the best free cash flows right now, but I also don't think it's the worst. We have some positive momentum. Netflix has their free cash flows going more positive than negative over time, and they're keeping their expenses under control. I'm going to give this one right now a B. Now, the reason I put Intel and Netflix in the same category, the same B ranking, is because Intel's has gone down over the past year, Netflix has increased. So directionally, they're moving in different directions. Intel has more total free cash flow, but it's going down. Netflix has less, but it's going up. After Netflix, we have Berkshire Hathaway, the Buffett company. Let's go ahead and jump into this. I think we do the -B on this website. You can look at Berkshire Hathaway that way. Let's go ahead and jump into their free cash flows. Now, when I look at Berkshire Hathaway's, we can look at the long history of this company, and the major focus for Warren Buffett and his investments, because he's a smart investor, is always the cash flows. He does not care about the earnings or the EPS. This number gets thrown around by his stake in different companies. It's basically meaningless to Buffett. In every shareholder letter, he says, look at the operating income. Look at the cash from operations, which is what the free cash flow is calculated from, not the earnings of the company. This is the reason we look at the actual cash flows of the company. And what we see at a glance here is a company that has an incredibly long history of generating a lot of free cash flow. It does have some minor volatility, little bit back in 2007, 2002, but not much overall, much better than most companies. When we also factor in the stock-based compensation, this is something that Warren Buffett is adamant about. He's spoken out about this many times. He doesn't like it when companies take the actual profits and they just siphon it up to the top to all the executives. So you look at these stock-based compensation, I can't even see it. There's not enough here that it even shows up on the bar chart. Again, we can look at this on an annual basis. Here's what the free cash flow looks like on an annual basis. Strong trends of growing year over year for the past decade or so. We factor in the stock-based compensation. Notice how it's basically missing. There's not enough here for it to even show up. Warren Buffett does not dilute the shareholder. He respects the shareholder to a huge extent. So I look at this company. The judgment here is quite easy. It doesn't get much better than this. Warren Buffett and Berkshire Hathaway is obviously S tier. Berkshire Hathaway is a free cash flow generative machine with growing free cash flows that doesn't dilute the shareholder. That's part of the reason why I have that one as a small holding, and I plan on adding to it in the future. Now, another one that was heavily requested is NVIDIA. This one is obviously a very popular stock. I don't own it currently. I just don't understand the industry quite as much as I'd like to jump into these investments. And my biggest issue with these type of investments is that they seem to be more cyclical than other industries. The boom and bust in the chip making market in general is something that I'm concerned about. Now, when I do look at the free cash flow profile of NVIDIA, it does look pretty strong. And the growth is, it's just incredible. Look at this. Over the past couple of years, it's just skyrocketed up. So they've really gone through a good time. But what I would highlight again is that it does ebb and flow. From 2008 to 2009, the free cash flow went from being in the positive by a huge amount to actually going negative. Then it took multiple years to get back up to the point of where it was back in 2008. So it is a more cyclical, I think less reliable type of free cash flow than something like Berkshire Hathaway. At least that's what the history shows. If we filter and look at the actual quarterly, we can see the most recent numbers, and the free cash flows are starting to decline again for the past 2 quarters. If we factor in stock-based compensation, again, this one is the silent killer. If you don't factor in the total expense of paying an employee, and you only factor in their salary, but you don't look at how much they're giving away in stock to employees, it can give you a different impression of how much cash flow is actually able to be returned to the shareholder. Because as they're paying these employees, growing amounts and executives, growing amounts of the shares in stock, they're diluting you, the shareholder, and you have less claim over the cash flows of the company. I look at this, and this is a trend I don't like seeing. Massive amounts of stock-based compensation with the free cash flows declining a little bit. But over the long term, since 2014, the cash flows are growing as well. I think that this looks very strong. My opinion, right now, this is one of the stronger looking companies, but I wouldn't consider it S tier simply because of the stock-based compensation. I'm going to put this one right up here in A tier. Next up, we have Unity. This company, I believe, is a newer listed one. It's a smaller company. It's actually not that small, though. It's a $13 billion company. That's still pretty big. It's been crushed over the past year, down 75%. Ouch. Anybody that bought in this company over the past year, they're hurting a little bit. Now, Unity, before I even go into the numbers, Unity is incredible. The software they create and the engines that they have that drive video games and make realistic physics in video games, it's all incredibly impressive stuff. So when I look at the numbers here, detach the actual numbers of the company and the stock from the actual product, I think the product is incredibly impressive. I can see why people want to invest in a product like this. I actually think, my opinion as a developer, I think it's quite impressive. When we look at the numbers here, though, I have to be honest here. This is one of the worst that I've looked at. We have a $14 billion company. This company doesn't really make any type of actual positive cash flows. We have one quarter where it did $80 million, but we look at this and it's minus 50 million, minus 58 million. Last quarter was minus 80 million. We had another quarter in 2021, minus 100 million. Cash flow is going out all the time. Even worse, we look at the stock-based compensation. They have cash flows going negative and growing stock-based compensation. Now, to give you an idea of how much this is in stock-based compensation, they paid $154 million in stock to employees. And then their total revenue last quarter was $322 million. So stock-based compensation made up roughly half their total revenue last quarter. That is probably the most dilutive that I think I've ever seen. So when I look at this company, there's no way around it. If you're invested in this company, the free cash flow profile right now looks awful. About as bad as it can get. What you're hoping for as an investor is to see this just improve over time as a lot of the investments they're making and the cash outflows they're making end up paying off down the road. Maybe over the next 10 years that will happen, but right now, this one it's bad. I think it's actually, if I had more tiers, I think this one's worse than Tattoo Chef and Amazon. Now, after Unity, we have a much more established company, Microsoft. Let's go ahead and take a look at this one. Microsoft, I often say, is the poster child for good fundamentals in a company. When you look at it, basically everything looks great. The revenues, the EBITDA, net income, earnings per share, all of it around the board. Now, when we look at the actual free cash flows here, likewise, this doesn't look too bad either. Microsoft has been a cash generative company for a long period of time, even during the Ballmer years, even during the years where they had a lot of mismanagement, a lot of ventures that they went into that didn't work out. The company still generated a lot of free cash flow. That just shows how good their core business was, their suite of Microsoft products. But then when Satya Nadella took over, he made it all subscription based. He really brought the company unified under the Azure, the whole Azure umbrella, and the profits and the cash flows have really taken off. We see steady growth since around 2013. We look at the stock-based compensation here. It's not as good as Apple, but it's still really good. Really, really good. Last quarter, for example, they generated $17 billion in free cash flow. Only $2.1 billion went to stock-based comp. This is a company that has discipline with their hiring, with their payments, with the growth of their company. So I look at this one and I think that the cash flows are tremendous. They're growing over time and they're relatively reliable because the majority of revenue from Microsoft is subscription-based. If I look at Microsoft, this is one that I'm going to be putting in the S tier category. The reason that I think it beats out Google is because I think it's less cyclical in its free cash flows and it's doing a lower proportion of stock-based comp. Now, next up, we have Palantir. Palantir. This is one that's really popular amongst social media. I think the product likewise is pretty impressive of what Palantir is doing. I actually think it's a pretty incredible product. It goes through and connects lots of data and does things to help companies create more efficiencies. It helps the government track terrorists. It does lots of really great things. It actually serves a good purpose. I can get behind the product of this, but let's go ahead and look at the current financials of the company. It's a growing company. It struggled like many software companies this year, down 55%. When we look at the actual cash flows here, they're not great. And again, the same argument would apply here. They're investing in their core business. They're trying to grow the amount of clients. They're not optimized for free cash flows right now. That's what you have to think if you're investing in Palantir. Of course, the free cash flow profile doesn't look amazing because they're optimizing for the future, not for right now. But the data is the data. Right now, they're not generating really significant free cash flow. Past couple of quarters have been tens of millions, so 50 million, 32 million, 20 million. And we look at this as a company that has a $17 billion market cap. So a $17 billion market cap generating $50, $60 million of free cash flow per quarter. Then when we factor in the total expense of paying an employee, the dilution happening here, it makes it look a little bit worse. The amount of dilution is more than the total free cash flow basically every quarter. Now again, I look at this company as one that if you're investing in it right now, you have a very long-term view what this company will look like over the next 5 to 10 years. You think the product and the services that they offer have a moat, it'll continue to have a competitive advantage, it'll grow, and eventually all the investments they're making right now will generate significant free cash flows in the future because it is priced that way. It's a $17 billion company. This thing has to generate real cash flows in the future. The stock price is going to continue to get hurt. But as of right now, on the current financials, this is another one where it's not there right now. It's in the early stages. It needs to mature and grow a bit. Hopefully their investments will pay off, but this one, like Amazon and Tattoo Chef and Unity, it's right there in the F tier. Now, next up, hidden behind my camera, we have Meta here. Now, Meta is a company that has had a very difficult past couple of years. I thought that it was a concern when they were going so heavily into the metaverse, and that was a complete direction, a huge pivot from what their business was to what it is now. And I sold out of the company when they announced that. Now, the company has come down in price a lot. It's down 65%. So the value proposition of Meta has changed a lot. But it's a $300 billion company now. They have the metaverse, and then they have their core businesses. Let's go ahead and look at the actual numbers here. What we can actually see on paper, not hypothetical predictions about the future. What we see is a company that since 2012, the early days of the company, it has generated a growing amounts of free cash flow. And this is, of course, from the continual growth of Facebook.com, of Instagram, these powerhouse apps that have billions of users every single day, that local businesses, they rely on these companies to advertise. Lots of companies spend so much money on these platforms to advertise. When I look at this, I think the free cash flows, obviously, over the past year have declined to almost nothing. So it's down to like $300 million in free cash flow. That's basically an all-time low since going back to 2012 with Meta. So something's happening here. And when I make my assessment on this company, I have to factor in not only the current situation, but the historical situation. I think that Meta can generate a lot more free cash flow than they currently are over the past year if they really made it their focus. So I think it has the power, the propensity to generate more free cash flow. But right now they're tanking their free cash flow by their investments into the metaverse and huge CapEx spending that they've been doing over the past year. They've also had an issue, like Google, with just overhiring. They expanded so fast over the past couple of years. In fact, they've doubled their employee count since 2019, an increase of 94%. Just incredible. A massive increase in the amount of employees. And these aren't retail employees. These are engineers. These are software developers. These are people that get paid in part by stock. So you see the amount of dilution climbing since 2019 by about triple. It actually went up around 3 times. Back in 2019, it was $1 billion per quarter. And last quarter, they paid employees $3.1 billion in stock-based comp. So we see the negative trend here of free cash flows over the past year declining while stock-based comp is going up steadily. And to investors, that's 2 things moving in the direction that we don't really want to see them move. If stock-based compensation goes up, you at least want free cash flows to climb at an accelerated speed. So Meta is a more complex one. I think that Mark Zuckerberg will turn this around. When I look at this one, I'm going to put this in the A category. It's not perfect right now. It needs some work. Zuckerberg needs to get things under control a little bit. But the long history, the 10 years plus of Meta churning out free cash flows quarter over quarter, give me a strong level of confidence that they can in the future. So I'm going to put this one right there with Google. I don't think it's S tier. I also don't think it's B tier. I think it fits firmly in the A tier. All right, next up, we have a controversial one, a very popular one, Tesla. I don't currently own this company, but I've owned it in the past. I actually had really good gains on it. I owned it around, I think, $400 a share, and I sold it around $750 back when that was the price of it before all the stock splits. So I made around 100% returns on it. It was a small holding, but Tesla's always a company that I've really admired. I want to get back into it. If the price gets low enough that I think I have that margin of safety, that's when I'm going to be jumping back into it. Now let's go ahead and look at the current financials of Tesla. Boy, has this company come a long ways. Charlie Munger just recently called this company a small miracle. And I think that's true. I think it's just a miraculous story how this company's evolved over time. We look at the free cash flows, and the history shows us most of it was negative while they're doing their big CapEx investments. Anything involving making cars, whether it's EV or ICE vehicles, either way, it's going to require a massive amount of CapEx. You have to build these big gigafactories. You have to have all these robots and everything, assemble it. It's a big outflow of cash to build these factories, but you can see it paying off. People are now paying a premium for Teslas, and they're paying in addition to software that they're selling on top of the car itself. So we see the cash flows now, since 2018, have a strong, rapid climb upwards. Very strong momentum upwards. Do you really have ownership of these cash flows? Are they generating them without diluting you, the shareholder? When we look at the stock-based compensation, and surprisingly, and I think very impressively, Tesla has not gone along with this trend like Google and Meta of having their stock-based compensation just continually increase out of control. You see the trend of it climbing in 2020. They're doing a lot of hiring at that point, but now it's actually in decline. They're paying less and less, generally speaking, every quarter in stock-based compensation since the past 2 years. So a trend of stock-based compensation, employee expense going down while free cash flows are going up. So when I look over Tesla's full free cash flow profile, right now it actually looks really strong. I think the thing that I'm wondering, the thing that's missing is Tesla really wasn't a mature company during a full market cycle in 2009. So we really don't know what's going to happen in the next recession. Will this company be far more volatile, unpredictable like Ford and GM, or will it sail right through the next recession and sell cars like crazy with as much demand as they've always had? I think that's what's missing from the picture. Tesla's a company that right now, I have to say it has a very impressive free cash flow profile. I rate this one as an A. If it can continue on in its trend and actually go through different market cycles like recessions and continue to generate growing free cash flows, this one will bump right up to an S. Now looking at this overall so far, I think we got it right. I think it looks pretty good. Let's go ahead and continue on. We have 4 more companies. Next up, we have Airbnb. This is one that I really haven't done a lot of research on because Airbnb is a company I've never used. I've literally never stayed at an Airbnb. I don't know. I just think it's weird to stay at someone else's house. I can see why some people like it, but Well, we've just never done it. I stay at hotels, resorts, places where their whole business is that, not just part of it. So this isn't one that I've done a lot of research on. I haven't used the product. I know about it just secondhand, hearing about it all the time. Let's go ahead and look at this one. I really haven't looked at the financials of this one too closely. I know it will have growing revenue. That looks great so far. We actually pull up the free cash flow here, and surprisingly, it actually has a trend of growing free cash flows. About $500 million. Let's see what they've done in terms of stock-based compensation. Someone got paid big here. Some executive walked out with a lot of money right there, $2.8 billion. After that, we have the normal employee stock-based comp, around $200 million per quarter, which eats up sometimes around half to around a fifth of it. So it's good that it's growing over time. Stock-based compensation does eat into a lot of it. I think the free cash flows, generally speaking, look decent, but I wouldn't call this one S tier. For me right now, I think Airbnb would be another B company. Pretty good. I think it's in the right direction, but I wouldn't call it amazing. I don't think it belongs with Tesla or Google. I also don't think it belongs with Disney. I think it fits right there in the B tier. Now we have DoorDash, another one of these more startup-like companies that's trying to scale very quickly. Let's go ahead and take a look at this one. DoorDash is a service I've used before, and I think it has multiple issues, incorrect orders, lots of parties involved. It's very expensive, but it's a good premise overall. It's food that appears at your door. And anytime you can have food just appear at your door, I think that's a good thing. So I think they have a good premise of a business, but they have a lot of things to fine tune. The company's growing very quickly. Let's go ahead and pull up the cash flow profile here. We have the actual free cash flows. Most of the quarters it's actually positive. Couple $100 million, $90 million. A couple of quarters ago it was minus $100 million. And this is for a company that's $24 billion. So you're paying $24 billion for a company that generates $50 to $100 million per quarter in free cash flows. Factor in stock-based compensation, and this looks pretty ugly. The company right now is not generating any cash flows for the investor. They're diluting you and your equity in the company faster than they're generating cash flows. I look at this and I think it's a very weak current free cash flow profile. And this one's debatable. Is it a C or an F? I'm not sure on this one. I think I'm going to throw it down here with the F category. It's just not enough. They're out diluting the shareholder. There's no strong trends of it growing either. If you're investing in DoorDash, you're basically believing over the long term, a lot of things are going to change. Based on the data we know right now, the information we have, the company's not producing any wealth for the shareholder. Now let's go ahead and talk about Cloudflare. We have ticker symbol NET. This is a company that was popular in 2021. Lots of investors were in it. Now this has kind of fallen out of popularity as the stock price has plummeted. But Cloudflare, in my opinion, has always been a very expensive company. Just too expensive. No matter how good their product is and their security and the things they're doing, the company has a $17 billion market cap. It trades at a price to sales of 20 times. So it's trading at 20 times its trailing 12 months revenue. Just incredible. When we look at the free cash flows, they also do not look promising. Every single quarter, aside from one, is in the negative. Cash flows continually going out quarter after quarter. And again, this is a $17 billion company. If you had $20 billion, would you want to spend almost all of your money buying this entire company, where you're going to be losing more money every single quarter? Then you factor in stock-based comp, and it just looks downright awful. This looks really bad. The stock-based comp is climbing like crazy, as the free cash flows don't climb at all. They remain completely flat. Might change in the future. Again, if you're invested in Cloudflare, you're expecting down the road these fundamentals are going to evolve over time. You're expecting the investments they're making to have big returns in the future. But right now, I see this as an extremely expensive company. $17 billion for stock-based comp going up, paying lots of money to employees and executives, no money left over for the shareholders. This one, in my opinion, is easily in the F tier. The free cash flow profile is not strong. Now let's go ahead and take a look at the last one here, Estee Lauder. This is a company in my portfolio. I've been buying into this one heavily because I think right now, in my opinion, again, I'm no pro, do your own research, but my opinion, I think the company's undervalued. We look at Estee Lauder and it's the beauty king with L'Oreal, right? They're the two big ones and they've been around for a long time. And this company in particular has grown for a long time. Since we have a long history, I'll bring up the annual view here. We can see how this company's done over the past couple of decades. Doesn't get much better than this. Growing free cash flows for literally 20 years straight. Strong trend, always positive. Every single year delivering real profits to the shareholders. Now, another thing we can factor in with this, of course, is the dilution they're doing. And they do have some, they are paying employees, but the amount that they're diluting the shareholder is minimal. So I see this as a company that has a very long history of growing free cash flows through all different market environments. It's proven itself time and time again. It's a very defensive industry, and they have good cost structure. They have good discipline in their business management. In my opinion, I think that Estee Lauder is one of the few that deserves an S tier rating. There's not too many companies on planet Earth that have a better free cash flow profile than Estee Lauder. So that's it. That's all of them. All the companies we have to rank this time, and I think it looks pretty good. You can disagree. Let me know. Let me know if I got them wrong. But I think this is pretty accurate looking back at it. It's interesting to see how this played out. I didn't have any mapped out plan. This is just what it looks like. Now, if you enjoyed this type of video, let me know. I might do more of them in the future. I'll see you in the next one.